From the moment you sit down to trade, the market hands you a mirror. The numbers reflect not only price and volume, but your own impulses, habits, and narratives. Apurva Parikh's The Trader's Mindset starts with this uncompromising observation and refuses to let psychology be the forgotten half of trading education. The book doesn't promise secret indicators or guaranteed systems. Instead, it hands traders a map for navigating the inner weather: fear, greed, impatience, ego, that turns smart plans into impulsive losses. Right away, the first lesson is clear. Mastering external strategies is futile if the internal environment is unmanaged. That lesson becomes the root from which every other rule in the book grows. Discipline, risk control, routine, patience, and the capacity to learn from failure are not separate techniques. They are stages of psychological development that lead one into consistently profitable behavior. If this is your first time, subscribe so you don't miss out. Let's continue. Parikh frames trading as a human process wrapped in probabilistic outcomes. Where many novices see charts as prophecy, the experienced trader learns to treat every trade as an experiment with an expected value, not a destiny. That shift, from betting to experimenting, is transformative. When you view a trade as a hypothesis to be tested, you stop demanding that the market validate your worth and start demanding that your process be validated. This is where discipline begins. The ability to create repeatable, testable rules and to execute them without being hijacked by emotion. Parikh's 21 rules are practical scaffolding for this transformation. Each rule tightens one aspect of the trader's behavior so that decisions rely less on story and more on process. The embedded lesson here is that credibility in trading accrues from small, repeated acts of restraint, not from the glamour of large, impulsive wins. Connected with the experiment mindset is another lesson Parikh emphasizes again and again: smallness and simplicity win. Build positions you can sleep with. Design stops you will respect. Prefer a sequence of small, correct decisions over the intoxicating possibility of one spectacular outcome. History is littered with traders who grew audacious after a streak of wins and promptly surrendered gains. The market's cruel lesson that confidence without guardrails becomes overconfidence. The practical countermeasure Parikh prescribes is simple: position sizing and risk per trade. By limiting exposure, traders protect capital and preserve options. In turn, preserved capital enables learning. You cannot learn if you are wiped out. Thus, risk management is not merely risk avoidance. It's the necessary condition for sustained education in markets. From the safety of good sizing and stops emerges the next lesson. Consistency beats complexity. Parikh urges traders to choose an approach they can implement consistently and to resist the gravitational pull of ever more complex systems promising more edges. Complexity breeds operational error, second-guessing, and overfitting. The better path, and one Parikh repeatedly champions, is to codify a handful of rules and rehearse them until execution is reflexive. This consistency creates a feedback loop. Predictable behavior produces predictable performance data, which produces better informed adjustments. When the market presents an outlier, black swans, flash crashes, or meme frenzy squeezes, a consistent framework allows the trader to interpret, respond, and learn rather than panic. The retail frenzy around meme stocks in early 2021, for example, showed how consistency and discipline mattered. Those who treated the event as a speculative, high-risk anomaly and sized appropriately survived, while those who abandoned their rules chasing maximal upside suffered catastrophic losses. The GameStop episode is a vivid case study of what happens when narratives and social momentum overpower disciplined sizing and risk protocols. Wikipedia. That real-world episode underscores another lesson Parikh builds into his narrative. Social dynamics and modern information flows materially change trader psychology. The democratization of trading platforms, the viral nature of social media, and the rise of commission-free brokers turned speculation into a social sport. Platforms and forums amplify fear and greed by turning trades into stories that reward visibility and immediate action. Parikh doesn't moralize the phenomenon. He prescribes mental tools: awareness, skepticism, and the deliberate cultivation of solitude during decision-making. Where crowd emotion surges, the trained trader reduces position size and tightens criteria. Where retail exuberance creates non-fundamental spikes, the disciplined trader either observes or treats participation as conscious speculation with explicit time and risk limits. The broader lesson: context matters. The same market move under different social conditions demands different responses. From context awareness flows the requirement to control attention. Parikh stresses that attention is finite and trading is saturated with distractions, breaking news, notifications, commentators, and the endless churn of data. Successful traders practice attention hygiene. They decide what they will monitor and what they will ignore. This is not passive avoidance, but deliberate prioritization. The practical technique is to set information windows, specific times to update your analysis, and to automate or delegate everything else. The cognitive benefit is profound. When you train your mind to be present only where and when it matters, your reactions become calmer and more adaptive. A calmer mind lowers the probability of emotional errors and fosters clearer, evidence-based decision-making. In periods of crisis, such as market collapses driven by global shocks like COVID-19 in March 2020, traders who preserved attention and focused on high-quality signals were better positioned to protect capital and to find selective opportunities as volatility created dislocations. Attention control then begets a softer, but equally important, skill: humility. Parikh argues that humility in trading is not defeatist, it is survivalist. Humility is the willingness to accept that you will be wrong, to limit ego-driven exposure, and to treat winning as informative rather than proof of genius. Humility manifests as the trader's log, candid records of trades, rationales, and outcomes. The log is a diagnostic tool. It reveals biases, recurring mistakes, and the emotional triggers that lead to poor decisions. By leaning into a practice of honest record-keeping, a trader converts subjective impressions into objective data. Humility plus logging produces the discipline to review and adjust strategies, not abandon them after random noise. This approach turns every losing trade into a lesson and every winning streak into an inquiry rather than a coronation. The reflective practices, logs, post-trade analysis, and humility yield another lesson. Process improvement is iterative and empirical. Parikh borrows scientific language, form hypotheses, set metrics, run trades as experiments, and iterate. He forbids the gambler's fallacy of attributing luck to skill without statistical evidence. The book encourages traders to define what better means: lower drawdown, improved win/loss ratios, or reduced reaction time, and to measure against those definitions. This focus on measurable improvement separates transient winners from long-term survivors. It also reframes failure. Drawdowns are not moral failures, but data-rich events that, if analyzed, accelerate learning. In other domains, this is routine. Software teams run A/B tests. Athletes use video review. And Parikh insists traders import the same empirical rigor into their craft. Iteration and metrics lead naturally to a discipline Parikh calls emotional regulation training. Just as athletes condition the body, traders must condition the mind. He presents exercises, breathing, visualization, pre-trade rituals, designed to reduce sympathetic arousal and keep the prefrontal cortex engaged in decision-making. These techniques are not spiritual fluff. They have cognitive neuroscience underpinnings. Stress narrows attention and promotes primitive reflexive behaviors. By rehearsing calm under simulated stress, small losses, sudden news shocks, whipsaw price action, traders build tolerance to the physiological states that otherwise drive impulsive errors. The lesson is pragmatic. The better your emotional baseline, the more faithfully you can execute your process. This is where posture and routine meet cold probability. As emotional regulation becomes a practiced habit, new opportunities appear. The capacity to hold positions when everyone else capitulates. The capacity to cut losses when the plan is invalidated. The capacity to reassess strategy during regime shifts. Parikh frames these capacities as psychological muscles that must be trained deliberately. He argues that traders must cultivate two complementary dispositions: courage and restraint. Courage to accept that market pain is sometimes the price of longer-term advantage, and restraint to refuse action when action is not warranted. These traits feed each other. Restraint protects one from reckless courage. Courage prevents paralysis. The interplay produces a mindset that can survive multiple market cycles. Those market cycles bring us to another fundamental lesson in the book: humility about predictability. Markets are complex adaptive systems. Cause and effect are often obscured by noise. Parikh recommends a mental posture that balances scenario planning and probabilistic thinking. You can map many outcomes and assign likelihoods, but the world routinely produces low-probability, high-impact events. Therefore, prepare with robust contingency plans, stress-tested position sizes, and mental rehearsal for rare events. The 2020 COVID crash is a textbook example. It was a black swan for many portfolios, and traders who had prepared contingency scenarios and had low concentration or flexible liquidity could either reduce risk or capitalize on the dislocations that followed. Preparation is not prediction, it's resilience. Wikipedia. This stance on unpredictability also shapes Parikh's guidance on leverage. He treats leverage like a scalpel. It amplifies both profit and pain. The lesson merges math and psychology. While leverage can mathematically improve expected returns, it also increases emotional pressure that degrades decision-making under duress. Parikh's practical counsel is conservative leverage, transparent stop logic, and mental readiness for the volatility leverage brings. Importantly, he ties leverage back to process. If you cannot follow your plan under the stress that leverage creates, you should not use leverage. This is a recurring theme. The market doesn't punish ignorance as much as it punishes mismatch between capacity and method. As traders internalize the above pillars: experiment mindset, risk sizing, consistency, attention control, humility, iteration, emotional regulation, and conservative leverage, Parikh turns focus to time horizon and alignment. He insists traders be explicit about whether they are investing or speculating, what timescales they operate in, and how their lifestyle aligns with those choices. Confusion about time horizon creates chronic dissonance. Day traders forced to hold overnight due to fear, or long-term investors trading impulsively because headline noise triggered FOMO. Clarity about horizon simplifies decision rules. If you're long-term, you don't scalp intraday noise. If you're intraday, you don't let overnight events dictate your stop logic. Time horizon alignment prevents role conflict in the brain, which otherwise leads to inconsistent rule application and suboptimal outcomes. From role clarity follows the need for risk parity within one's financial life. Parikh emphasizes that trading psychology is deeply contextual. Stress from work, relationships, or health amplifies market stress and produces poor choices. He recommends traders set aside dedicated capital for speculative activities that they can afford to lose, mechanically separate from essential assets. This financial compartmentalization reduces existential pressure during drawdowns and allows clearer, more rational trading decisions. The lesson: mental freedom in markets starts with sensible life finance. You cannot be calm trading with your rent money on the line. Having built these personal and procedural defenses, Parikh next addresses the social infrastructure that supports lasting improvement: mentors, communities, and critique partners. He warns against echo chambers that celebrate risk-taking and short-term heroics, and advocates for feedback networks that provide dispassionate critique and accountability. The idea is straightforward. There is psychological insulation in social systems that normalize process over outcomes. Well-chosen mentorship shortens the learning curve by highlighting pitfalls you haven't yet encountered. In a world where social media celebrates one-off windfalls, finding a steady, experienced voice can be the difference between development and ruin. Parikh's recommendation is to seek mentorship with people who have prescriptive, repeatable frameworks and who will hold you to them. With external accountability in place, Parikh returns to the internal architecture and drills into cognitive biases. He catalogs the usual suspects: confirmation bias, loss aversion, recency bias, and survivorship bias, and shows how each distortion wrecks otherwise sound plans. But he goes further. He provides practical cognitive hacks to interrupt these biases. For instance, intentionally creating devil's advocate hypotheses before taking a trade reduces confirmation bias. Automating stop losses reduces loss aversion's hold. Maintaining rolling performance metrics counters recency's overvaluation of recent results. These tactics are small parlor tricks with outsized effects because bias acts like a tiny leak that deflates long-run performance if ignored. One of Parikh's subtler but more powerful contributions is his reframing of failure. Instead of moralizing loss or celebrating winners, he normalizes failure as necessary data. He encourages traders to design safe-to-fail experiments that intentionally limit downside while allowing for learning. This approach removes the stigma from losing trades and converts them into stepped experiments. For example, testing a new indicator on micro positions rather than full sizes. Over time, this builds an empirical library of what works in your hands and temperament. The lesson is that a mature trader treats the market as an instructor. Each failure offers an answer to a question you maybe didn't know to ask. Parikh weaves that empirical stance into guidance on strategy diversification. He argues that the best portfolios are composed of uncorrelated edges rather than a single killer method. That contrasts with the romantic myth of the lone genius with a secret system. Real resilience comes from method diversity, momentum plus mean reversion, trend following plus volatility arbitrage, carefully sized so that no single failure destroys the whole. The added psychological benefit is reduced outcome salience. When one edge struggles, your identity and emotional state remain intact because you have other methods producing or preserving value. The book then steps into an operational realm, building routines. Parikh emphasizes that routines create cognitive bandwidth by standardizing low-value choices. What to check, when to check it, pre-trade checklist. Routines act like autopilot for execution, allowing your conscious mind to focus on analysis and adaptation. He prescribes pre-market rituals, clear entry and exit checklists, and evening reviews. These rituals integrate with the trader's log and create the virtuous cycle of execution, reflection, refinement. One intertwined lesson is about environment design. Parikh suggests traders deliberately shape their physical and digital environments to reduce triggers for impulsive trading. Remove one-click buying from non-strategic apps, limit notifications during critical periods, and design workspaces that cue focus. The environment is often the unsung lever of behavior change. A small nudge, a complexity-reducing app setting, or a do-not-disturb chain during market open can prevent catastrophic snap decisions. This ties back to attention hygiene. Design matters. Parikh also discusses the concept of mental thresholds, explicit emotional limits beyond which you will not make decisions, e.g., after 3 losing trades in a day I stop. If I lose X% of account, I take a cooling-off period. Such thresholds are meta-rules. When your internal control is compromised, automatic external constraints protect you. Implementing these thresholds reduces emotional drift and prevents escalation. They are pre-commitments that your future stress self cannot easily override. At a higher level, Parikh teaches traders to integrate their trading identity into a broader life narrative. Traders who see their work as part of a long-term craft, rather than a get-rich scheme, are more likely to behave in ways that sustain practice and learning. Identity shapes habit. If you identify as a student of markets, you pursue process and feedback. If you identify as a winner, you chase outcomes and stories. This identity work is both philosophical and tactical. It shapes daily practices and the patience to withstand inevitable variance. Linked to identity is the lesson of gratitude and detachment. Parikh suggests small gratitude practices that reduce emotional reactivity. Detachment exercises help traders accept uncertainty without personalizing outcomes. These practices don't make you immune to pain but change the emotional valence. Losses become inconvenient data rather than moral indictments. The cognitive freedom that emerges allows traders to stick to plans through noise. Near the book's close, Parikh turns to career-level thinking, compounding of learning, and the meta-skill of adaptation. He emphasizes that trading ability compounds like interest. Small improvements, repeated over years, generate outsized advantages. Traders who prioritize daily marginal gains in process, decision latency, and emotional resilience outrun those who search for dramatic system changes. The meta-skill is adaptation. Markets evolve, regimes change, and traders who habitually update their models without abandoning core principles survive and thrive. This is an ecological view. Success is about fit to the environment and the ability to evolve with it. To ground his principles in recent reality, Parikh uses practical case studies and modern market examples. The retail revolution, commission-free trading, fractional shares, and social trading platforms created a new class of participants whose behaviors amplified volatility and created narrative-driven episodes, e.g., meme stocks. The lesson: market structure shifts can change risk profiles, and traders must continually reassess their strategies in light of structural evolution. For instance, the rapid ascent and dramatic whipsaw in GameStop during January 2021 teaches a brutal lesson. Liquidity and narrative can become primary drivers of price, and when that occurs, traditional fundamental or technical rules may behave unpredictably. The correct response is to step back, tighten sizing, or engage with explicit speculation rules rather than conflating speculation with investment. Wikipedia. Similarly, the global shock of COVID-19 in March 2020 taught the industry about correlated systemic risk. Markets collapsed sharply across geographies in a few days as liquidity evaporated and correlation spiked. Traders who had stress-tested portfolios, kept cash buffers, or had explicit contingency rules were better positioned to either protect capital or to act opportunistically as central bank interventions and fiscal support created rebounds and mispricings. The practical lesson here is to always plan for broad, cross-market events, not only isolated asset-specific shocks. Wikipedia. The social and platform side of trading also mattered after 2021. Brokerages that once encouraged retail participation by lowering fees responded to extreme events with temporary trade restrictions and margin changes, illustrating operational counterparty risks that can affect execution and strategy viability. Traders must account for platform risk, including margin calls, liquidity constraints, and operational halts, in their planning. The pop-up crisis around platform limits during meme stock episodes highlights the need to test strategies across different operational scenarios and to have contingency access to capital or exit channels. Reuters. Taken together, Parikh's lessons read less like a collection of tips and more like a progressive curriculum for psychological fitness. Start by shrinking size and clarifying your hypothesis. Build routine and attention discipline. Cultivate emotional regulation and humility. Iterate with logged metrics. Diversify method. Adapt to environment and platform changes. And finally, compound small improvements over years. Each lesson builds on the previous because each psychological skill enables the next stage of tactical competence. Discipline begets clarity. Clarity begets calibration. Calibration begets resilience. Resilience begets growth. To make this practical for traders today, Parikh's book closes with actionable micro-routines that can be implemented on day one. A pre-trade checklist that includes entry logic, stop, size, and a stated hypothesis. A post-trade log template for rational, not emotional review. A weekly review that measures process metrics, not just P&L. A simple breathing and visualization routine to stabilize the nervous system before active markets. And an accountability partner or mentor to serve as a reality check. These micro-habits are deliberately small, by design, to encourage adoption and to kickstart the compounding effect of marginal gains. Across the global and American perspective, the lessons scale. In emerging markets where liquidity and regulatory shifts can be more frequent, Parikh's stress on risk sizing, contingency planning, and attention control is vital. Structural shocks can be swift and severe, so preserving optionality is paramount. In the U.S. markets, with deep liquidity but intense algorithmic and retail activity, the same psychological rules apply, but the operational detail changes. Speed and automation matter more, and social media-driven narrative spikes, e.g., the GameStop episode, demand rapid sizing discipline and platform risk awareness. From London to Lagos, the behavioral core is identical. Human cognition is the constant and markets the variable. Parikh's curriculum is adaptable. The specifics of execution may differ across geographies, but mindset and process are universal. The final, overarching lesson Parikh leaves the reader with is moral and practical. The market will not reward bravado, nor will it spare those who neglect their inner training. Trading success, in his view, is a long-term alignment of psychology, process, and context. It asks for humility and tenacity in equal measure. If you treat trading as an athletic discipline rather than a lottery ticket, preparing the mind as carefully as you prepare the system. You create the conditions for compounding skill. Over time, that compounding is what separates transient lucky streaks from a career that can weather shocks, adapt to structural change, and harness the inevitable cycles of greed and fear to your advantage. If this message resonated with you, subscribe and join us for more wisdom that fuels growth.